Everyone. Okay, glad to see you are all hopping in and joining us today. Thank you so much for being here. We are using Zoom for the first time, so bear with us in case we have any technical difficulties. And we would love to get your feedback on the session. We've been using GoToWebinar for years, and we'd like to try this. So if you love it, if you hate it, please let us know. A few things will be different here today, and so I'll just run through a few quick things. So to start, thank you for making time in your busy schedules to be here with us today. This session is about how you can easily answer your clients' top 6 financial questions and compare options to improve outcomes. My name is Alex Mercer, and I'll be your host today. I'm joined by my colleague, Steve Arnott, Snap's Financial Planning Project Lead, who will provide today's demonstration and run the Q&A. Additionally, we've got an exclusive offer for those of you who would like to explore a free trial of Snap's financial planning software at the end of this session. Now, before we get started, I'd like to make sure that you can see my screen, that you can see Steve and I, that you can hear me. On the bottom of your control panel, there is a Q&A button. You can click that, open it up, and that's how you can send me or send us a private message. If all of you could send us a quick smiley face or a question tab through that question, that would be great, just to let us know you can hear us. And if you want to send something publicly, you can send it through the chat, and that's how I will send everything out for you guys. So wonderful. Thank you so much. I can see those responses coming in through the Q&A. So Steve and I have our cameras turned on just to say hello. We are going to shut those off to give you a full screen view of our presentation. So I'm going to click my video off here. And there we go. Okay, so some of you here today are already using Snap projections for your financial planning needs. For those of you who aren't already familiar with Snap, Snap is a Canadian financial planning software platform. We help great financial advisors grow their assets under management and receive more referrals through effective financial planning. If you want to hear from other advisors who are already using Snap, you can find reviews numerous places online. For example, on Capterra, which is an independent third-party software review site, you will find advisors saying things like none of their clients retire without a Snap projection and that the software has become foundational to their firm. As you can see, we are currently sitting at 4.9 out of 5 stars. We have been in market for 10 years, enthusiastically serving the thousands of financial advisors, planners, and investment managers who partner with Snap to grow their assets under management and increase quality referrals. And we are thrilled to share that Snap is now fully available in French. We are now providing customer support and product demos with a French language team member. So let's think about the why behind financial planning. We all know what's good for the clients, but what is the real value of having a financial planning process in place for you and your practice? We know that investment and insurance products are essentially the implementation part of a financial plan. Without the plan, how can you effectively communicate the value of your recommendations? Snap has been in market and speaking directly with advisors for 10 years now. What we have discovered is that successful advisors and successful advisory teams pretty much always have a financial planning process in place. Sometimes it's a light process, or maybe it's more in depth, that's going to depend entirely on your client base and what their needs are. But the common denominator to building a sustainable and growing financial advisory practice is almost always the same. A financial planning process is in place. Without that process, it's going to be harder for you to build a sustainable and successful practice. Financial planning helps to create the foundation for a strong client advisor relationship. It builds trust. That trust makes it easier to deliver financial advice and provide behavioral coaching so that you can help your clients keep their emotions in check and avoid doing things like buying high and selling low. There have been studies on the value advisors can add to their clients' lives through relationship oriented services. Morningstar calls it Gamma, and Vanguard calls it Alpha. Since financial planning focuses on addressing direct and practical questions for clients, it drives value. When you're speaking your client's language and meeting them where they're at, they talk about their experience to friends and family, which keeps the referral and client acquisition wheel turning. Building trust from the onset makes it easier to turn those prospects into clients. Happy clients stay, which means that financial planning also increases the lifetime value of a client. Succession planning is going to need its own dedicated session, but it's been proven time and time again the concrete value financial planning brings to the table when it's time to sell your book of business. So, with all the value that is generated from financial planning, and this is for both the clients and the practice, why aren't more advisors doing more planning? Here's what advisors tell us. Problem number one, data entry takes me too long. It can easily take hours or even days to collect the information from clients and enter it into a planning platform. Second, it takes me hours to develop the projections. One plan alone can take 10 to 15 hours, and that just isn't scalable or practical. Third, my clients don't want or understand complex 50-page reports. Their eyes glaze over. Lastly, I can't run quick what if scenarios with a client in real time. Often, the adjustments and discussions throughout the planning process turn into multiple back and forth meetings that essentially burn the clients out and cause them to lose interest. So, how is Snap going to eliminate these challenges for you? Data entry does not have to be a problem for you anymore. Snap is going to provide you with a questionnaire that simplifies the data collection process, ensuring you get the information you need. Plus, you'll be provided with a streamlined process to quickly and effectively enter your data into the software. You're going to see Steve do this in just a moment. It should not take you hours and hours to build simple plans. With Snap, you can build a basic plan in less than 20 minutes, and you're going to see that today as well. And what good are your reports if your clients can't understand them? Snap provides you with clear, engaging reports that have been designed for your clients. You have numerous options to choose from to ensure a highly personalized presentation. But what we'll focus on today is the one-page snapshot report summary. And lastly, building out multiple what if scenarios should not be a cumbersome process. It should be simple and easy enough that you could do it with your clients present if you wanted to. With Snap, you can build multiple what if scenarios in real time. A few clicks, a few seconds, that's it. You can compare up to 5 scenarios on one page, which is exactly how you can prove your value as an advisor. Steve is going to show you how to do this in just a moment. Now, there are many Snap users who have come to us after struggling with other software, particularly NaviPlan and Conquest. And these are the 4 things they all say keep them using Snap. Number one is transparency. When you need to explain something to your clients, you need to first be able to understand it yourself. I talk with advisors all the time who tell me that if they cannot see how the numbers are being calculated, they feel uncomfortable presenting the plan to their clients. Next comes flexibility, customization, and control. Without that, you can't model your clients' lives accurately or make the plans truly personal. Next, Snap is easy to learn and easy to use. Lack of ease of use is one of the biggest barriers to software adoption. If it's hard to use or the learning curve is steep, no one wants it. There are no barriers to getting started with Snap. You simply sign up online, gain instant access, and get to work with an intuitive program. Last, but certainly not least, comes customer support and service. If you're not using Snap, I'd encourage you to ask your colleagues what their experience working with our team has been like. And I'd also encourage you to compare these response times with your current provider. Our team will also screen share with you over Zoom or Teams. This means you're not stuck emailing screenshots back and forth, waiting for answers when you have a client meeting that same afternoon. So, what you're about to see here, as I hand this over to Steve, is that Snap will show you where the numbers are coming from. You'll see how much flexibility and control you have within the software and how straightforward learning to use the program will be. So, we've talked about how planning helps the advisory practice, and we've covered how Snap will eliminate the most common planning challenges advisors are running into. Over the last decade, our research has continued to find that there are six main questions and concerns your clients want answers to. The $1 million question: Am I going to be okay? How much can I afford to spend? When should I take my government benefits? What order should I draw down my assets in once I retire? Am I saving enough? And how much will be left for my children? Snap has been designed to easily answer these questions and more for your clients and to show them their options. These are the six questions we are going to tackle now live in the software. So, Steve will start with showing you the basic profile setup in Snap Projections. To run a simple projection and answer some basic questions, we just need to enter a few data points: name, date of birth, province of residence, income, current asset holdings, and any planned contributions. That's it. And what you'll see here is that this data entry process is only going to take Steve about 7 minutes. And that includes him taking the time to explain the steps as he goes. You'll see that with Snap, we can be quick and simple, or we can conduct comprehensive financial planning. So I'll get Steve to take over now and log into Snap.
Terrific. Thanks so much, Alex. And thanks again, everyone, for joining us today. Snap Projections is a web-based platform, which means that you can access your account from any Chrome browser on any computer without the need for a download. You'll go to snapprojections.com, and then in the top right corner, you'll have the option to log in with your username, password, and the option for a multi-factor authentication. I've entered that during today's session, so I'll click Login and go directly into the software. I'm taken initially to my clients page where I can access any of the projections I've created in the past, or I can get started on a new client file by clicking Add New Client. Before we begin the data input process, I want to start by showing you the final deliverable that we're going to be creating today for our client, Angie Warren. This is a one-page snapshot that provides a high-level summary of the projection that we created and gives the client actionable next steps in order to move forward with any of the recommendations. We can see there's a summary of the client's goals, when they're going to retire, how much they're spending, whether they're on or off track for that target, how much they're expected to have in assets over time, where their retirement income will come from, how much will be left for the estate, and then some customizable text with recommendations and next steps. And this page will be able to address all six of those questions, and we'll show how that can be done at the very end of today's demonstration. So let's get started, and we'll create the base scenario for Angie Warren. So I'll start by inputting her name and date of birth, 1975. And she's currently living in British Columbia. In the top left corner of the software, you'll see that there are three main sections to the tool. The first step is the scenario setup, where we can enter in all of our base plan data. This includes things like client details, general plan settings, expenses, incomes. Once we're done with the scenario setup, we will then proceed to the planning pages, where all of that information comes together to show us Angie's life on one page. From here, we can review information, make changes on a one-off basis or for any period of time throughout the plan. And then once we're comfortable with all of the numbers, we'll proceed to the client report where we can select the charts, tables, and commentary we would like to include in a final client-facing document. For now, we'll continue on with the scenario setup. I'll click Next at the bottom, and we'll go to the General Plan settings. We're going to begin the projection this year in 2025 with a target retirement age of 60 and a projection length until age 100. We've pre-populated the inflation rates based off of the FP Canada guideline assumptions, and then I've adjusted the rate of return assumption from the gross value that FP Canada guideline assumptions provide, reducing that by expected management fees to arrive at a net rate of return. Clicking next, we can go to the expenses page, and there's a lot of flexibility in how you enter expenses into SNAP. If you have a client's budget or a target spending level, you can input that information directly here. If you don't have that yet available, you can wait and leave this page blank. And then when you get to the planning pages section, SNAP can help calculate what a reasonable budget would be based off of a few different calculation options. In this case, we do have a target retirement spending goal, which is $48,000 net of tax per year, and this is going to be adjusted for inflation over time. We can also enter in additional expenses. So in this case, Angie's looking for additional travel of $10,000 per year. We'll index that for inflation, start it in the first year of retirement, and run that until age 74. We'll also highlight that in the chart so that we can draw attention to the funded status later in our discussions. Clicking next, we'll go to the incomes page where we can enter in Angie's current salary, which is $110,000 per year. If we want, we can index that income at a specific percentage, or I can link it directly to the general inflation rate that we had set on the previous general page. That's being entered as employment income, so SNAP will automatically deduct CPP and EI. It will also tax it appropriately and earn and track additional RSP room. It'll start in the first year and then run until the end of the year prior to her retirement. If we'd like, we can add other incomes such as a rental property, or we can enter in defined benefit pension plans. In this case, Angie is expecting to receive a pension starting when she retires at age 60. The benefit, including her bridge for the period before age 65, will be $35,000 a year. And then from 65 on, once the bridge benefit ends, she expects to receive $28,000 per year. On the assets page, you'll see that SNAP automatically adds a default non-registered account to each projection. And this serves as an example of how to input a account in the software. And it also provides SNAP with a location to allocate future surpluses if required. In this case, I'm going to repurpose the default account and just replace that with her current non-registered information. So she has a savings account with $50,000, and that's currently sitting 100% in cash. She also has a tax-free savings account with $120,000 invested as 30% fixed income, 70% equity. And you'll see that the rate of return values from our general settings page have been pre-populated for each individual account, but I do have the option to change that rate of return for any specific asset on any specific account if I expect it to be higher or lower than my default average. Continuing on, she also has a RSP with $325,000, similarly invested as 30% fixed income and 70% equity. Now that we've entered her 3 investment accounts, you'll see across the top of the table that there are tabs for each of the registered account types. And this is a common theme throughout SNAP, where you can get started with a quick and simple projection using default conservative assumptions, or you can come into those settings pages and refine those assumptions in order to really tailor the plan to your client's unique circumstances. So in this case, we can see that SNAP defaults to assume that the client only has contribution room available for the current calendar year. If they have additional carry forward from a previous year, you can adjust that value here. For Angie, because she's up to date with all of her previous year contributions for the TFSA and RSP, we'll leave both of those contribution room calculations as they are. Going back to the assets section, I'll scroll down to the real assets page and input her home, which has a current value of 750,000, original cost of 450,000. We can set our desired appreciation rate, enter in a future purchase age or sale age if applicable. So if a client's saving up for their first home, they want to downsize in retirement, or they're selling an investment property, you can model any of those transactions directly from this page. And then you can indicate whether there are capital gains tax applicable to any of those transactions. Continuing on, we'll go to the debts page and input her remaining mortgage, which has a balance of 145,000, interest rate of 5%, and monthly payments of $1,600. We can link that to the home so that if we do sell the home at any time in the plan prior to the mortgage being repaid, Snap will use the proceeds to finish off the remaining mortgage balance. And lastly, we'll click Next and go to the government benefits page. From here, we can control the start age for both CPP and old age security, and we can set either the dollar value that the client is expecting to receive or the percentage of maximum based off of their employment history. In our base scenario, we're going to assume that she starts taking CPP at 65, and you'll see that SNAP defaults to the national average of 57% of the maximum. This is done because we don't have the historical employment income and contribution data to be able to calculate it directly. So we assume the national average, and then you can adjust that based off of the information you have available from the client. So in this case, we'll assume that Angie will receive 75% of the maximum once they start receiving it at age 65. Scrolling down to the old age security, we'll start that at 65 with 100% of the maximum. And just like that, as Alex had mentioned, we've been able to enter all of Angie's base data in about 7 minutes time. On the left, you will see that there are additional pages available as needed. So we could enter life insurance policies, education for RESPs, tailor additional settings throughout the plan, and enter corporations as needed. But for Angie's case, we're all finished with scenario setup. We're ready to click on planning pages and see how all of the data that we've entered so far can come together to show us Angie's life on one page. Now, the planning page can seem overwhelming the first time you see it, but once you know what you're looking at, it's a very intuitive and powerful section of the software. On the left, we have the year and our client's age. We then have the calculated cash flow that is left over from all other inputs currently in the plan. So this $62,770 is calculated by taking the employment income of 110,000, subtracting off CPP and EI, subtracting off taxes, and then subtracting off her mortgage payment. That leaves Angie with $62,770 to allocate towards personal expenses or savings. There's a lot of other great data on this page, such as the taxable income, marginal and effective tax rates, the client's account balances, any contribution or withdrawals, the assumed rate of return. And then we have the home, mortgage, net worth, and estate information. And any of the blue and purple values that you see throughout the planning page are fully customizable. So if I want to make a contribution to the TFSA for a particular year or for a period of time throughout the plan, I can click on the contribution value, enter in my desired contribution amount, and then copy that down for a set period of time. Once I make a change to the planning page, the Run button in the top right corner will turn from green to orange. And this means that I've made a change that has not yet been recalculated throughout the page. And we do that intentionally to prevent Snap from constantly changing the numbers on you as you're making edits. And then once you're finished, you can click the Run button, it'll turn green, and it'll recalculate everything throughout the page. Before I click Run, I'm just going to make an additional contribution to the RSP for $6,000 a year and index that for inflation. Now I'll click Run, and Snap will take a moment to recalculate everything. And you'll see part of that recalculation process is that Snap has changed my $20,000 annual contribution request to be the annual maximum expected each year going forward. So SNAP has guardrails in place to prevent you from accidentally over contributing to an account if there's not enough contribution room expected to be available. So now that we have the TFSA and RSP contributions, we can go back to the calculated discretionary cash flow. So now there's 51,630 left for items outside of the projection. And that process continues by default until the final year of work. And then once she retires at age 60, we can see that our target retirement income goal of 48,000 a year has kicked in. It's being inflation adjusted forward to that future year. And we also have our additional travel inflation adjusted for that year. And that spending is being funded through a combination of our pension, and then SNAP is withdrawing automatically from the financial assets in order to reach the total cash flow required. So we can see SNAP adjusts the amount coming out each year as CPP and OAS begin at age 65. We can see that the withdrawals decrease. And then eventually the registered money starts getting taken out. And by the end of the projection, we're expected to have about 500,000 in the TFSA and 100,000 remaining in the RRSP. So this would suggest that Angie is on track for her target goal. With another 10 years of savings, she should be able to spend 48,000 a year, inflation adjusted throughout retirement, plus her additional travel goal. If we scroll back up to the top, we can also review this projection in the form of charts. So if I click on charts at the top, you'll see that I can review the base expenses. So this is how much the client is spending on an annual basis on items outside of the projection. And then we have the additional travel, income tax, debt payments, and contributions to financial assets. As we scroll down, we can see where her cash flow is coming from each year, whether that's employment income, government benefits, pensions, or withdrawals. And then we can see her net worth, which shows how much she has available across various assets each year of the plan. And all of these charts are fully interactive. So if I click, for instance, on the items in the legend, you'll see that it removes those from the chart to rescale things. And I can also hover my mouse over top of the individual bars in order to get more granular information. So now that we're done with our first scenario, let's quickly review those 6 questions that Alex showed us earlier, which is what we're going to progress through now by creating a few additional scenarios in order to answer each of these questions. So she wants to know how long her money will last, how much she can spend without running out of money, when she should take government benefits, which asset to withdraw from first, whether she's saving enough, and then how much will be left for her beneficiaries. So the first thing we're going to tackle in our next scenario is determining when she should take her government benefits. So if we go back to the plan, right now, as we saw, we're taking CPP and OAS starting at 65 as a default. So we're going to copy this scenario and we'll try to see what happens if she defers government benefits until age 70. So the first thing to do once I've copied this scenario is I'm going to retitle to scenario 2, defer CPP and OAS. And for that, I'll go back into scenario setup, down to government benefits, and then I'm going to change the CPP start age from 65 up to 70. And when you do that, there's a few adjustments that are occurring in the plan in terms of the expected benefit. There's the deferral value. There's also the enhanced CPP phase in that's still continuing. If your client will not be working during that 5-year period, you will want to exclude SNAP's calculation that's being done for the enhanced CPP changes. And you can do that by simply reducing the percentage of maximum by about 1% per year of deferral. So I'm just going to change that to 70%. And then I'll defer the OAS to age 70. So now that I've made those 2 changes, I'll go back into the planning page to review the outcome. We now have a full decade at the start of retirement with no government benefits, and then increased values once we start receiving them at age 70. You'll see that SNAP has automatically increased the amount coming out of the financial assets in order to fill the gap. And as we scroll towards the bottom of the page, we can see that there's now expected to be closer to 800,000 in the TFSA and about 100,000 in the RSP. So we've added around 300,000 of estate value at age 100 by deferring CPP and OAS. The next question that we want to tackle is what to do with her financial assets if she does defer CPP and OAS. So right now, by default, SNAP is using a tax deferral strategy, which tries to prolong the lifetime of the RSP in order to spread out the taxable income over a longer period. So we have early withdrawals from the savings account and the non-reg, and that is resulting in this case in a fairly low marginal rate at the start of retirement. So we can copy this scenario once more. I'm just going to update the title. So this will be scenario 3, defer CPP and OAS with consideration for an early RIF conversion. And there are a few ways that I can customize the withdrawals from the accounts in retirement. You have full control over the decumulation strategy. The one method that I'm going to use is to go into scenario setup, down to the assets page, and then back into those account settings that we showed earlier. We can change the assumed conversion age of the RSP into a RIF to begin taking the annual minimum right when she retires. So now that I've done that, if I scroll across to the RSP, you'll see that at retirement, we start taking the annual minimum. That's going to increase our taxable income and take advantage of that lower marginal rate while we have it available. As a result of that earlier RIF, when we scroll to the bottom, you'll see that it's now about 900,000 in the TFSA versus 800,000. So each of these changes we're making improvements, but less and less so each time. And we have been comparing the scenarios to one another as we've been working, but another tool that's available in Snap is a dedicated comparison analysis. So if I click on the menu, I can click compare scenario, and I can select all 3 plans in order to get a more granular and summarized view of the differences in those projections. So the first metric that people typically reference is the goal progress. So this is how much of the client's target retirement spending is funded through liquid assets. So here we have 111%. This is what we saw in that first plan where there was a bit of money still left at the end. When we deferred CPP and OAS, we increased that to 116% of a funded status. And then the RIF conversion added a bit more tax savings and improved our situation to 117%. And we can see what's changed between the scenarios, which is causing those differences in outcomes. So it's not related to retirement age. We can see that staying the same. We're still projecting until age 100 with the same average annual spending. What has changed is the total lifetime government benefits. So by deferring, we would receive an additional roughly 400,000 in the second 2 scenarios that we created. In the first deferral situation, we increased our taxes payable because we have more taxable income from the government benefits. And then by converting the RIF early, we reduced our total lifetime taxes, which further improved our situation. If we review the personal estate and compare the outcomes, we can see the differences in total financial assets at the end of the plan, and that translates into higher net of tax estate values in the third scenario. Now, this assumes that the client lives to age 100, which is helpful to know, but may not be applicable to the client and when they actually might pass away. So we can also review this outcome comparison by changing the final year that we're using for the calculations. So we could look at it as of age 90 if we want, or age 80, for example. Or if we want to see all of the estate after tax values for each year of the plan, we can click on trends and take a look at a chart that provides exactly that. So here we can see not just a single year and which plan is best, but over the entire lifetime, which plan is better in certain periods. So if we look at the base scenario, we can see that that's the preferred strategy if she were to expect to pass away between 65 and 75. And that's because she's taking CPP and OAS right away. She's getting to use that cash flow and she's leaving more of her financial assets to the estate. However, the longer that she lives, the more deferring CPP and OAS starts to pay off. And we can see that scenario 2 becomes preferred. And then scenario 3 is actually higher than scenario 2 in all circumstances and only less than the scenario, or the base scenario, in a few years. So in this case, what we're going to do is recommend scenario 3 because it's the highest expected outcome in the most likely period of the plan that the client might pass away. And all of the summary charts and tables that we've seen in the scenario comparison tool can be printed or saved as a PDF. So if you click print in the top right, you can either print that off as a page, or you can save it as a PDF and share it with the client. Similar ability exists for the summaries table. And before printing it, you can also select which metrics you want to include. So if you want to simplify the chart and just include a couple of metrics, you can select those metrics, save your settings, and then generate a PDF with that information. So now that we've decided that we're going to go with scenario 3, what we can do next is use the recommendations tool in order to provide some options to Angie about what she can do with her overfunded status. So right now she's got about 900,000 projected to be remaining at the end of the plan. And Snap has some quick calculators that can help us decide what to do with that money. The first option could be to retire earlier in order to retire, to have more years in retirement and still be able to spend her target goal of 48,000 a year. So this is saying that she could retire at 57 in order to use up that overfunded status and still be on track for her target goal. Another option, of course, would be sustainable spending, which will increase her total spending throughout retirement to 53,000 a year rather than 48,000. So with those options in mind, we're now ready to proceed to the third step of the plan creation process, which is the client report. We'll go into the report builder, which is where we can customize which pages we want to include and in what order. And there is lots of options available in Snap for your reports. There's information provided in charts and in tables, depending on the client's preferences. There's individual figures by spouse, as well as total household values. So what you can do is you can create your desired template, and we have some supporting articles and sample reports to help you with that process. We're also happy to help from the customer success team in order to get you set up with your desired report settings. For today's demonstration, I'm just going to simply create a one-page snapshot summary, which is what I showed at the beginning of today's demonstration. And to do that, I'm going to click on snapshots only at the top here. And that's going to filter out all of the other pages that might be included in other reports. So you'll see the cover page, note to reader, those are grayed out. They won't be included for this report. And we have the ability to use up to 10 summarized charts, tables, and comment boxes in order to provide a more simplified and digestible single page report. We can fit 6 of these 10 onto a single page, so I'm just going to pick the most relevant one for the discussion I'm looking to have with Angie. That will result in me removing 4 total pages, so I'm going to get rid of the assumption summary, and I can do that by just dragging it outside of the included pages list. I'm also going to remove financial assets, the net worth summary, and the expense summary. So that leaves me with 6 remaining. I could reorder them if I wanted, but I do like the default order, so I'm just going to keep that as is. Now that I've selected my report pages, I'll click on Report Editor. From here, I can go through each page individually and review the information that is included and make customizations if I need. So here we have Angie's retirement at age 60 in 2035. We can see her average spending before retirement, as well as her target retirement spending goal. The most important thing I want to emphasize here is that all of these values are referencing specific variables in the settings for the software. So it's not static text that you have to update if you make changes to the plan. These will all update in real time with any changes to this scenario or as you use this report with other clients. You do have the ability to enter in your own comments, either static text or using the templated variables. So if I say additional travel budget, and then at age of retirement in 2035, we can use the templates on the right in order to create our own custom comments. Here we have the goal status, which shows that 117% funded rate that we've saw a couple times previously. And then we have those calculated recommendations that we did from the planning page. And we can also add our own comments. So they could just, of course, have a larger buffer and leave a larger estate if they don't want to retire earlier or spend more. We can then see the final few summaries that will be included. We have the net worth over time, where the retirement spending is coming from, the estate summary, and then we have a recommendation summary text box where I can enter in additional comments to provide next steps, congratulations, anything that feels appropriate in the report. Now that we're done with the report editor, I can click report preview to make sure that I'm comfortable with what's being displayed. So we have the goal summary, status, net worth, retirement income, estate, and our comments. And now that I'm comfortable with all of that, I'll click generate PDF. And then I'll download the file. And now we can use the report in order to answer the 6 questions directly from Angie. So going back here, how long will my money last? Am I going to be okay? For that, we can show a few different options. The first would be the goal status. So she is overfunded for her target goal, which means that she is going to be okay. We can also show the total net worth expected throughout the projection and the estate information. How much can I spend so I won't run out of money? So we have her target spending goal of $48,000 a year, plus we've calculated her sustainable, which is an extra $5,000 per year on top of that. When should I take my government benefits? We've shown that in a couple different ways. The first is within the retirement income summary. We can see that the government benefits starts at age 70. And we've also added that that will likely be the best approach in our comments, but we've made a note that we'll revisit those decisions closer to with more information. Which of my assets should I spend first? We showed her that converting the RIF early does seem to make sense, but of course we will revisit that in the final stages before the decision gets made. Is she saving enough? Yes, we've been able to show the total amount that she'll have available based off of her current savings amount. And then how much will be left after taxes for my beneficiaries? The estate summary can show the pre-tax benefit or pre-tax estate of 3.1 million, the expected taxes payable, the net estate, and then an adjusted estate in today's dollars to account for inflation to provide a more realistic expectation of what that estate would provide. So we have been able to answer all of Angie's 6 questions. We've generated a 1-page report, and we've done all of that in under half an hour. We do have a lot of other tools throughout the Snap software, such as the ability to run stress-tested scenarios. So this would apply historical or randomized rates of return to the projection. We also have needs analysis to see if enough insurance is in place. We can add corporations. And the moment that you sign up for your free trial, you will have immediate access to our help site. So if you click on help in the top right and then go to help center, you'll be able to access previous webinar recordings, which can provide information on dedicated features and also best practices for creating plans in the software. You can also search for key terms to find articles, or you can give our team a call, send us an email, and we'll be happy to help on a one-on-one basis. With that, I'm going to pass it back over to Alex to walk us through a few next steps, and then we'll open it up for questions.
Wonderful, Steve. Thank you so much. Yes, we have covered a lot this hour, but we are here to address any and all questions in just a moment. We've had a ton of great questions come in already. So you saw at the beginning that we do have a special offer for those of you who are here with us today. We are going to give a special gift to every single advisor who signs up for a free trial of Snap Projections today. Each one of you who starts before midnight Eastern time today will receive an extended 1-hour onboarding and training session. Plus, we will set up your report branding for you, and we will help you to create and save your own personalized snapshot template, just as you saw Steve do here today. The snapshot is very flexible, but it's most often used in three different ways, according to what advisors are telling us. It can be used as a standalone client deliverable that essentially replaces the longer client report. It can be used as a 1 or 2 page quarterly or annual review. And it's also very often being used as the executive summary to the full comprehensive report. The beautiful thing about this is that once your template is created, your snapshot is automatically built from the data within your projections. No extra work is required to produce this report. As part of this special package today, the support team will work with you one on one to create your template so you can instantly pull a 1 or 2 page report from your projections. On our pricing page, you'll see there are two plans for you to choose from as an independent advisor. The advisor business is the plan you want for the corporate module. You can upgrade and downgrade anytime, so don't worry too much about which one you select today. If anyone would like to see the corporate module or the stress testing feature that Steve mentioned at the end, please let me know and we will try to cover that in the Q&A. So I've dropped the link to start your free trial in the chat. So you can click that now so that you have it. And I will send it out via email as well. When you create your account, you're going to get instant access to the software. And to ensure you can take advantage of the special onboarding and training package being offered today, just make sure you get started at some point today. Okay, so that takes us to our Q&A. Oh, sorry. No, back up. I forgot. I also wanted to mention in just 3 weeks' time, we have another webinar coming up. The FP Canada has just reopened the application process for CE accreditation. So our next financial planning webinar in March will be CE accredited, and it is going to be about tax planning strategies. This has been one of the most highly requested topics. So really excited to bring that to you all in just a few weeks. And invitations for that will come out next week. Thank you, Steve. And so now on to the Q&A. So we've got a ton of great questions here. So I'll try to get through as many of them as we can. So, number one, for French planning, do you incorporate the Quebec specific legislation requirements? I'm specifically concerned with the estate transmission of assets.
Great question. So we do have a lot of unique calculations in SNAP specifically for Quebec. Obviously, their annual tax calculations are quite a bit different than the other provinces and territories. That is all factored into the SNAP software. We actually have a release coming this week that further adds to those unique calculations. So from a tax standpoint, Quebec is factored in. The estate considerations are more flexible in SNAP. There isn't necessarily an assumption about how the assets will transfer or be distributed in the final estate itself. So for instance, if I go to the very last year and click on the estate, we can see the value of the estate, but it doesn't make any claims about how that will be allocated. So you can include comments or information about who will receive various assets and values within the report itself. So if you want to add comments or highlight that in your conversations with your clients, you can. The only thing really embedded in SNAP for estate considerations is spousal rollovers for the first spouse passing away. And we do have more information in articles, or we'd be happy to discuss that in more detail if you want to reach out to our customer success team.
Perfect. Thank you. And one question we can answer quickly here. There's questions about if support is available and if it's included in the subscription. So the answer to that is yes. So any advisor that signs up for SNAP has full access to the support team, which of course Steve is a member of. So there's no additional cost for one-on-one support and training while you are using SNAP. Next question we will do a few questions around adding spouses to the plan. So, can you show us how to do that and just highlight what looks different? And then we've had a question around specifically seeing the RIF and LIF income being split between a spouse and how that works.
Okay, perfect. So yes, when you're creating your initial plan on the client's page, typically you would add the spouse at this stage of the data input process. So you would just click add spouse, you would enter in their first and last name. And then once you have spouses in the projection, you'll see at the top here that the scenario setup essentially gets split between the two of them. So the expenses page, you can enter in specific expenses for Daryl as well as for Angie. On the incomes page, naturally, we'd be able to add the employment income for Daryl. If I tab back to Angie, we can see the data that we entered earlier. So once you add a spouse, you'll have the same sort of input capabilities as you did for Angie. But it does also add a lot of unique functionality specifically for spousal situations. So for instance, within the assets, now you'll see that we can add a spousal RRSP as the type. You'll also see that we can base the minimum RIF withdrawals on the age of the younger spouse. And if we go to the planning pages, we'll be able to see things like pension income splitting automatically happening throughout the software. So if I go to Daryl, we can see that he's receiving 17,500 of pension splitting from Angie in the first 5 years of the plan. Sorry, jumping back to Angie, we can see that on both of their pages. So it's splitting up to the maximum that it can based off of the eligible pension income. Once the RIF begins, we can see that the total pension income splitting increases in order to try to equalize their taxable income. So those are some of the features that get incorporated once you have modeled a spouse as well.
Perfect. Thank you. Can we cover the options for life insurance and how to use the needs analysis tool?
Perfect. So if we go back to scenario setup and then into insurance, you'll see that we can add insurance policies of various types. So we can enter term, whole life, or universal. Depending on what type you're entering, you'll have access to the different fields that would be relevant. So whether that's the death benefit, the premium, the cash surrender value. So you would enter all of the insurance information here. You can indicate how the beneficiaries are assigned. And then ultimately, once that's been entered, you would be able to see all of the insurance data on the planning pages. So it would get added as a separate section on the planning page all the way on the right. So we would have our insurance section. Once you've added all of their insurance, then you may want to conduct needs analysis to see if enough is in place. And to do that, you would click needs analysis, life insurance, and then you'll see that we can conduct that either for Angie to see if enough insurance is in place for Angie's life, and then separately for Daryl. And from here, we can enter in all of our preferred settings for how we want to calculate the insurance need, whether we want to do an income replacement assumption where we cover 70% of the spouse's income for a 10-year period, or whether we want to do an expense coverage calculation where we look at how much the survivor will need to spend per year, how much the survivor will have in available cash flow, and then we fill that gap for a set period of time. So there's different ways that you can calculate the annual coverage required. There's also the ability to pay off things like the mortgage at death. You can indicate if you want to cover things like the children's education, tax on the estate if applicable. So lots of customizable settings depending on how you want to run that analysis. Again, we do have dedicated articles and webinars focused on the use of that tool. We're also currently expanding our needs analysis capabilities and insurance in SNAP. So you'll see disability and critical illness is coming soon. That's currently being worked on by our product development team. So we're excited to launch those in the near future.
Fantastic. And okay, so next topic here will be corporations. We've got a few different questions about corporations. Can we demonstrate how the corporations are integrated into the plan? Can we have more than one corporation? And then just questions about seeing dividends from the OpCo and the HoldCo, and just covering what we do for RDTOH and CDA, please.
Perfect. So you can add multiple corporations to your scenarios. You will have to be on the advisor business subscription. So when Alex was showing the two pricing options, that would be the higher tier. So that'll give you access to add multiple corporations to any of your scenarios. When you add the corporation, you'll have the ability to enter in things like the name, and then the province, the small business deduction rates or amounts. You can enter in existing RDTOH balances, existing capital dividend, GRIP. All of these values are calculated by Snap going forward in the software automatically. So the active business income is going to get taxed appropriately based off of the small business deduction and the rate. If you earn more than 500,000, that's going to be above the business deduction, and that'll get taxed at the regular income rate. If you have passive investment income, that's going to get taxed at the full marginal rate and earn RDTOH. So all of that is automated throughout Snap going forward. These balances are only for any starting amounts that the corporation already has today. You can, of course, leave these blank if you don't have that information available yet. That will just make the software a bit more conservative because we won't have those tax assumptions available or those tax savings available. But you can come back and add that information as you get it in future conversations. So that's how you can kind of set up the corporation. There's lots of options in terms of the tax calculation and timing for disposing of the corporation in the future, whether that will be done as a capital gain or dividend distributions. You can then add assets to the corporation. So let's say that it has some investments. We could add in real assets for equipment, property. We could add debts, insurance within the corporation, and that's going to track the cost base, the death benefit. It'll automatically calculate the capital dividend if applicable. So the insurance module is fully built out. If we then proceed to the planning pages, this is where Snap is a bit unique in that it can actually model both the OpCo and the HoldCo within a single corporation. So on the left, we have the active OpCo considerations, the operating income, any salaries being paid, the expenses. That's going to get taxed appropriately based off of the small business deduction rate or based off of the general corporate rate. And then on the right, we have essentially the HoldCo. We have any passive income that is not being generated from the portfolio within the software. So this could be things like rental income on a portfolio of properties. They also have the investments, which are generating passive investment income on an annual basis. And this is all being taxed at the full marginal rate and then earning the appropriate notional account balances. We can see in the top right the accumulation of those notional account balances. So you have lots of information available to dig in and help plan from a tax standpoint. And then you can model things like the income, the salary or dividends being paid out, and then anything entered on the corporate planning page would automatically carry over into the personal page. You'd be able to see that information, and it would also get factored into the cash flow. So lots more that we can cover with the corporation. I would encourage you to check out our 10-minute kind of tutorials on the corporate module just to give you a better sense of the range of capabilities and how we recommend setting those up.
Fantastic, Steve. Thank you so much. Well, watching the clock here, everyone, we are out of time. If your question has not been answered yet, I will follow up with you via email. A reminder to get that free trial started today so you can take advantage of our special offer. The recording for this session will be available. I will send it out to everyone tomorrow. And thank you so much for making time in your busy schedule to be here with us today. Enjoy the rest of your day, and I'm looking forward to continuing the conversation offline. Thanks again, and bye for now.